Good afternoon, everyone. We'll wait for a couple of minutes before we start, Thanks. Hi, good afternoon, everyone. My name is Raminder Bhatia, and on behalf of ASK Investment Managers, I welcome you all to the knowledge series on ASK products. Today, we are discussing ASK India Select Portfolio. Today, we have with us Mr. Chetan Thacker. Chetan has a total work experience of more than 15 years with 10 years plus in equity research. He has a sector research expertise in agriculture, chemicals, metals, mining, and mid-caps. Previously, Mr. Thacker has worked with McKinsey, HSBC Invest Direct, MK Global. His education qualification includes CFA and PGDPM from NMIMS. He is with ASK since 2015. Today, we have scheduled an hour for this webinar, wherein I would request Chetan to cover the broader trends in the market for 10-15 minutes, followed by a deeper understanding of ASK India Select, giving an insight on what happened in calendar year 22. Where do we stand now and how we see things going forward? This would be followed by Q&A. I would request all of you to type in your questions and queries related to the portfolio, and we shall curate and try to get them answered. So Chetan, thank you so much for joining in, and all over to you now. Thanks.
Thank you, Raminder. Thanks for that. Good evening, ladies and gentlemen. Thank you so much for giving us time Monday evening. So like Raminder was mentioning, the way we structured this discussion is we will touch upon the backdrop of both global and domestic macros, what has played out in CY22 and how we see things shaping up going forward in CY23. We will follow that up with a deeper understanding on the India Select portfolio, how it is positioned at this point of time, what do we expect from the portfolio going forward in terms of earnings, and then we'll open the floor up for question and answer session. So before we begin, we will obviously just quickly touch upon the investment philosophy and the process here at ASK. So the India Select portfolio itself is obviously built on this same investment philosophy of identifying businesses which are run by high quality management, running high quality businesses. We continue and we have a very sharp focus on size of opportunity, which is one of our key attributes that we look at when we analyze any particular company for it to be part of the portfolio. And this is extremely important, that size of opportunity should be large and it should be an expanding opportunity size, which is if married with the right quality of management and right quality of business, essentially delivers earnings compounding over a length of time, which in turn leads to wealth creation. So this is the core investment attribute that we look at while we are building these portfolios, and it remains consistent even with the India Select scheme. What does this essentially translate into? It essentially translates into a fact that we look at businesses where there is greater certainty of earnings growth, as compared to mere quantum of earnings growth. So we would prefer businesses where certainty of the earnings is high, and we wouldn't like businesses where the uncertainty is higher while quantum can be significantly better than the one where certainty is extremely high. Further, we look at businesses which can deliver superior and consistent quality of earnings growth. Quality of earnings is equally important as along with as opposed to the quantum of growth itself. Quality is important because a high quality business and a business which is improving its quality, when we say quality, we essentially mean capital efficiency, will translate into higher cash flows which this business can generate. And if done and delivered consistently over a period of time, it essentially creates wealth and leads to not only returns which are in line with the earnings growth that one experiences, but because of improving quality of earnings itself, you additionally add some quotient of re-rating, which is the extra that you get delivered over and above the earnings growth. A third important aspect is we would prefer businesses which are high quality at reasonable prices versus businesses which are lower quality in nature and just arithmetically appear cheap. So we are focused on identifying businesses which are high quality and populating them at a reasonable price as opposed to looking at arithmetic cheapness. Moving on to the global macro, I think this is extremely important. What CY22 witnessed was a high degree of volatility. There are certain structural aspects which transitioned in CY22, which hold a lot of backdrop in terms of why we are where we are today. So CY22 was a year when we essentially saw inflation shoot significantly higher. Inflation was building up ever since the world started to open up after the first wave of COVID. There was initially a belief that inflation that we are witnessing is to do with the supply chain issues that were prominent across different parts of the geography because each country was following its different approach of opening up. While once that phase was over, I think central banks soon realized that inflation is not only mere a function of what we see in terms of supply chain bottlenecks, but it had already turned sticky. And that can to some degree also be attributed to fiscal expansion that most of the developed world began as they started to counter COVID and looked at fiscal expansion as a measure to support their population in the difficult period of the lockdown. As we moved ahead in CY22, which is towards the middle of the first quarter, we obviously witnessed the war in Europe. What that essentially meant was we saw a spurt of increase in commodity prices. That spurt of increase in commodity prices essentially meant that most of the cash-rich companies felt that there was a need to stock inventories because commodities would not be available given that we were still facing a situation where China was operating on the zero COVID policy, which meant that bottlenecks were still there in the supply chain. So everyone started to grab inventory at that point of time, assuming that as the world opens up, there will be significant demand which needs to be serviced. As we transitioned towards the second quarter of the calendar year 22, what we witnessed was first the war itself meant that Europe went into a situation where there were clouds emerging on demand. That was essentially driven by a sharp increase not only in the energy costs globally, but we also witnessed a sharp increase in agriculture costs. That meant that inflation had a phenomenon of higher energy cost and agriculture cost, and few factors within that were something which could not be addressed in the near term and would need a more policy-driven longer-term approach to solve, which meant that inflation in the near term could remain sticky. And this is all on the backdrop of fiscal expansion that we had witnessed. To this, we suddenly saw central banks act finally after a gap, and we saw a very sharp increase in cost of capital. So what we are witnessing today is we are essentially witnessing a period where the central banks started to increase interest rates because inflation has started to get sticky, and we started to see rapid increase in global cost of capital. Now, this is a phenomenon which is getting reversed after a length of time, and we started to see cost of capital globally moving up. If you look at how growth has fared in this period, so essentially 2020 is the period where globe was most affected because of COVID. 2021 was a period where things were bouncing back very clearly. As we look ahead in 2022 and 2023, it's quite evident that there is a scope that is being built in where global growth, the GDP growth itself is getting moderated. That is driven by most of the developed world witnessing a moderation in growth. India clearly stands out as far as the growth rate is concerned in 2023, and we expect India to remain one of the large economies which continues to accelerate above 6%. On the inflation front itself, given the backdrop that I had shared and the fact that most central banks started moving aggressively to increase interest rates with an aim to curtail and control inflation, what we are witnessing is obviously right now we are still going through a period where cost of capital is going up. It's largely driven by US Federal Reserve, which is tightening rates. But on the annual, if we start to see, we have started to see some degree of inflationary pressures coming off. That is largely right now to deal with the fact that most of the commodity prices, after hitting an high in the initial period of the war, which was somewhere in the period of March, April, May, we started to see commodity prices cool off. A big reason for this cool off is there is anticipation that demand itself will be lower because of the sharp increase in global interest rates that we witnessed. Club that or marry that with what we are witnessing in Europe in particular, because of the war, there is a high degree of uncertainty there. While looking ahead to CY23, there is a belief that opening up of China will provide some fillip to global GDP growth. But if you were to believe the forecasters, which is the World Economic Outlook, they believe that China will still grow at a moderate rate compared to their own historical past, as the focus there shifts towards more internal consumption. So what we are starting to see now is some bit of these lead indicators where commodity prices have started to cool off. Having said that, what is crucial and what is most important to note is the fact that we will start central banks responding to inflation only once they believe that the inflation expectation has started to moderate. And that is when we believe that you will start to see reversal in interest rates. Very difficult to time it, and hence we are keeping a very close eye on what is happening in terms of the underlying drivers of inflation. So commodity prices have started to cool off to some degree, while labor markets continue to remain tight in the developed world. So that adds to the entire equation of inflation still remaining a tad bit sticky and expectations of inflations continuing to run high. Similar to the previous table, what we are witnessed in energy cost as well, oil has cooled off from the highs that we've witnessed. Oil is settling here to some extent. Having said that, we'll have to see how this moves ahead because this is one key factor and determinant linked to how China opens up and the demand that comes to the world market in CY23 from China. Similarly, on supply chain, while this was believed to be the biggest factor which was driving inflation to a large degree in the period of 2020, 2021, and to large extent beginning of 2022, what we've started to now witness is freight index, which is a lead indicator of how supply bottlenecks have started to get addressed. We are actually starting to see the freight index significantly go down and move back to the pre-COVID level, which essentially points and indicates towards the fact that the supply bottlenecks are steadily and gradually getting addressed, and inflation, which is related to same severe bottleneck issues, might get addressed as we move ahead. Agri-commodity prices, again, a fallout of what we had witnessed between Russia and Ukraine. We've seen agri-commodity prices spike significantly higher in the period of Jan, Feb, March, April of 2022. We have started to see some amount of cooling off of agri-commodity prices. It is also to do with the fact that some amount of supplies which were feared of not coming into the market have started to come into the market. Particularly wheat supplies originating from Ukraine that have started to come into the market. And in general, we are starting to see some amount of cooling off of agri-commodity prices as the expectation that disruption on the supply chain side, on the agri side, will still be limited. And we are starting to see the first and early signs of cooling off. However, this is to a large extent determined even on weather patterns. So we will be keeping a close eye on inflation which emanates from agri prices. On the domestic front, what this essentially means is that the fact that globally there is an environment where demand is getting weaker. What we started to witness is that as India opened up and domestic demand started to come back, we started to witness a widening of the trade deficit gap, and we started to see a trade deficit expand. Having said that, forex reserves are still sufficiently high to provide a decent enough cover. But external account is something that we'll have to keep a very close eye on. As you can see in this chart, oil and energy imports obviously are the biggest bill for the country. To a large extent, that was being compensated or is being compensated by IT exports. What we are witnessing in this current environment is while oil is a sticky import for us, IT export, the growth rate is expected to moderate a tad bit. Coupled with that, the widening of the trade deficit itself on the good side means that the gap is opening up on the deficit side. So we'll have to keep a close eye, particularly from an external point of view, as to how this trade gap behaves going forward and how energy prices to that extent behave as we move ahead. Once we look at a more micro picture on what is happening on the domestic side, which is the high frequency data, and there are obviously green shoots which appear there. GST collection continues to remain above the 1.4 lakh crore mark, which essentially means that the economic activity continues to move ahead. We believe there is a higher degree of resilience in the domestic growth that we are witnessing at this point of time, as export growth itself is under some degree of pressure because of the demand that we are witnessing both in Europe and in US and other advanced part of the world. It is in response to what is happening in terms of the expectation of growth there, plus the fact that cost of capital is going up. In a period of heightened volatility of commodity prices, the exports have also suffered from destocking of a lot of supply chains globally, and that has also impacted the outlook on the export front in the near term. While there is resilience on the domestic side, so as is visible from the composite PMI index, which essentially talks about expansion both in manufacturing and services. Diesel consumption, which again points towards more freight movement and movement in general in the economy, that growth continues to hold steady. While credit growth itself has surprised positively this year, we are starting to see fastening of credit growth, which means that there is a large degree of resilience of the domestic growth as it stands today. Our expectation is this continues to accelerate as we move into CY23. Given where the Rabi output is at this point of time and state of that crop, keeping fingers crossed, if that holds out, our expectation is volume growth starts to pick up on the domestic side, starting from the end of the fourth quarter and more so from Q1 of FY24. So on the macro situation in general, our expectation is rural starts to see recovery first. And that starts to happen from towards the end of Q4 and Q1. This is built upon Rabi going off smoothly, and that output, the yields which are there, which are expected to be there, those don't get impacted because of some degree of heat that we are witnessing at this point of time. Supported by this, the budget which has just gone by, I think the biggest takeaway from the budget is the acceleration in capital expenditure. The higher capital expenditure essentially means not only will it lead to improvement in the demand for a direct place to that capital expenditure, it also will translate into consumption accelerating as we move ahead and those capex start to get spent. So our expectation is the fillip of higher capex coupled with recovery on the rural side starts to provide an additional leg of volume growth as we move into FY24. Further to add, on the export front, while near term there are issues in terms of demand, there are few structural drivers which continue to remain in place. Those drivers essentially are that there is a clear focus from the government of getting India onto the manufacturing roadmap globally. What that essentially means that it adds an additional lever for growth for India. India has predominantly been dependent on services, and services have been the torchbearer for growth as far as Indian GDP growth is concerned. With a clear push from the government on the manufacturing side, be it through the schemes of PLI, which have been announced across various industries. The fact there is a global tailwind, which we are witnessing, where in any case, I think so in COVID, it got accelerated, where people were looking to move supply chains away from China. I think an additional lever has got added where people are even looking at Europe +1 as an additional driver. These structural factors will play out in the medium term and they bode exceedingly well for the growth of India from a more medium term point of view. So our expectation is tailwind on the global supply chain, putting India into the roadmap on manufacturing in the global parlance, and the fact that services has always been a stronghold of the country. We expect this essentially accelerates growth for India from a more medium to long term perspective. If you look at the expectations from GDP growth over a more medium to long term, I think that acceleration, which is expected, clearly builds a lot of this into place. What will happen as we progress and move ahead is you will at some stage start to see private capex also reviving as capacity utilization across the board picks up. Extremely difficult to pinpoint a timeline to that, but from a direction point of view, government capex will probably be the first leg which starts to accelerate growth as capacity utilizations improve. We expect private capex also starts to happen. The base of all of this is, and what is most positive is the fact that we are in a situation after a length of time where most of the corporate balance sheets have been deleveraged. We are in a situation where household balance sheets are extremely robust. We are in a situation where bank balance sheets now are extremely robust, and that can support an acceleration of growth. So we have actually come out of a very difficult period where we were stuck in a period where banks were stuck with or saddled with debt or loans which were obviously not performing. We were in a period where there were certain corporate pressures emerging in certain sectors. I think a lot of reforms from the government side have essentially cleared a lot of that, and that has meant that there is deleveraging which we witnessed on the corporate side. And this improves the runway for our growth from a more medium to long-term perspective. So these structural pillars are essentially in place for acceleration of growth. What we need to monitor is more from a short term. Short term, our belief is you will still see some degree of volatility. That volatility is largely emerging from what is happening in terms of expectation of cost of capital globally. It's emerging from what happens to demand from a global point of view. We've seen a first difficult phase of destocking that has happened globally. At some stage, we will witness restocking that happens, which will drive the first leg of growth from an exports point of view, while the tailwind continues to remain extremely strong of putting India into the roadmap of manufacturing. In terms of flows, which is again a fallout of all of these factors put together, what we witnessed in CY22 is we witnessed a 17 billion outflow from India in CY22. And that has clearly been one of the reasons why we've seen our markets under pressure in this year, because flows from a global point of view have been negative. What is interesting to note is the fact that while FII flows have been negative, there is obviously some amount of compensation that is happening from the domestic flow front. This clearly points towards financialization of savings. This is a theme which we believe will play out from a more long-term perspective. The resilience of the domestic savings itself into the marketplace, it's quite visible. We are continuing to see SIPs remain at a higher level as we move ahead. That even plays out in terms of ownership. Ownership patterns have obviously shifted a bit. We've actually seen, while FII ownership of the Indian market has dipped a bit, retail is clearly a winner there, followed by increase in market share of domestic MFs as well. So that clearly points towards a gradual and structural shift of the marketplace, where there is a significant amount of ownership which is now there by the domestic players, be it directly or be it through the route of mutual funds or insurance, while the ownership pattern of FII has kept on reducing. Our expectation here clearly is that as cost of capital settles globally, you see India as a port which is shining bright in what is happening in terms of global growth. These flows will essentially do what they need to do to move monies where it's most profitable for them. What is more important is the fact that there is another leg of supporting flows that has got developed, which is more domestic savers focused. Coming to the India Select portfolio, and a read across of all that we are witnessing is the fact that the way this portfolio is positioned today, it is essentially positioned to benefit more from the structural medium to long-term trends that we are witnessing. We essentially believe that if growth accelerates from a more medium to long-term, what it benefits the most is consumption. And even within consumption, we believe there is a degree of premiumization that will play out. There is this entire shift from unorganized to organized, and hence we are more dependent on discretionary kind of spend within our portfolio, which has a larger allocation within the portfolio. We believe as the economy gets richer, you will start to see the discretionary part continuing to drive growth, where not only you are witnessing a shift to organized, you are also witnessing a play of premiumization, and that in turn means a play on capital efficiency. Within financials, what stands out is obviously our weight directly towards retail side of financing. We continue to believe there is a large scope of opportunity which sits there. Household debt continues to remain low as the country moves ahead and as the country becomes richer. Not only is there scope which is available on the lending side of things, there is obviously scope which opens up even on the fee generating side of businesses. Insurance is one area where we are overweight compared to the benchmark. We believe there is a large degree of under penetration both in general and in life, and that will play out as the economy gets bigger, as people get richer. You will essentially see a need for protection, be it both general and life, that also starts to increase. Third key aspect which we were discussing was India emerging as a manufacturing hub. Our higher weightage versus the benchmark to themes such as chemicals, where we are overweight compared to the benchmark themes which are focused clearly on manufacturing, where we are overweight. Our belief is that from a more medium to long term, this will drive growth not only for the economy, but also in terms of the shift that we are witnessing and the emergence of India in the entire global manufacturing landscape. So these are 2-3 critical areas where the portfolio is positioned and remains overweight, and we believe here you will see acceleration in earnings growth from a more medium to long term perspective. In terms of how the portfolio psychography looks, this page essentially talks about if we were to assume that the portfolio itself is a single stock. So the way the portfolio psychography would look is that ROC for this portfolio in FY23 is 26%, 24 that improves, our expectation is to 28%. It is significantly better than the benchmark, which is at 15 to 16%. Earnings growth acceleration is what we are expecting in 24. That is built on 2 key aspects. FY23 was a year where there was obviously a benign base on top of which we saw a 23% growth. But if you were to look at it from a more micro lens, FY23 still was a year where volumes have been lackluster. We had witnessed significant amount of pressure on margins. As we moved along in FY23, I think Q2, which is the first half, saw the maximum pain of margin pressure. That pressure was largely because of the fact that most of the companies which had cash on their balance sheet in the first quarter of calendar year went ahead and piled inventory with the hope that they should have sufficient inventory to service the demand that they were anticipating from opening up of the globe. What eventually panned out was a situation where demand was lower. You started witnessing a fall in commodity prices, and all of that fall had to move from balance sheet through P&L, which meant that there was margin pressure. So we witnessed fair degree of pressure on the margins in Q1 and Q2. Q3 has been a quarter where we started to see improvement sequentially in terms of margins, while volume growth still continues to remain tepid. Our expectation from FY24 is you will see a convergence of both margin normalization improvement plus volume growth starting to kick in as we look at the period starting end of Q4 and more so Q1 of FY24. So we expect earnings to accelerate as we move into FY24. That in turn leads to improvement in ROC. So when we look at this earnings on the backdrop of the benchmark earning growth will still be in the range of 14 to 15%, while as the portfolio level earnings growth is significantly better at 27% with a better capital efficiency. So our expectation is FY24 witnesses an acceleration of earnings growth. Coming to the performance of the underlying companies in the quarter gone by, which is Q3, what we witnessed is, as I was highlighting, despite a tepid growth on volumes, we've seen improvement in margins. That has essentially meant that operating profit growth for the portfolio companies as a whole has improved by 21%, while PAT has improved by 16% as compared to the benchmark, which is at 12% and 9%. In FY23, for the year as a whole, as I was mentioning, operating profit growth is expected at 19%, while operating profit growth for the benchmark is expected at 14%. As we look ahead into FY24, we expect operating profit to accelerate, PAT growth to be better than operating profit growth, while on the benchmark, similarly, we expect a 16% growth. So our expectation is that we will see earnings growth for the portfolio, which will be significantly better than the underlying benchmark, with better capital efficiency and improving capital efficiency. Coming to the portfolio performance, what we would like to highlight here is the fact that while when you look at the numbers for a more 3-year, 5-year, 7-year period, what is being dragged down is clearly the performance that we witnessed in the current year, which is FY23 or CY22, where there is a degree of underperformance. The underperformance in the current calendar year and the current fiscal year is essentially coming out of 2 factors. When we look at the underperformance, close to 35-40% can be explained by selection effect. The balance is allocation effect. Within selection effect, what has impacted us is the fact that 2 exposures, particularly on the finance and auto side, which have been a drag for us as far as selection is concerned. Financials is something which we would like to touch upon in a greater detail. The current fiscal year, which is CY23, has been a year wherein banks have delivered stellar earnings growth. Not only private sector banks, we've also, after a length of time, witnessed performance improving for the PSU banks. What has essentially happened is they've been in an extremely sweet spot as far as CY 22 is concerned and FY 23 is concerned. On one hand, you have NIM expansion, which is largely driven by the fact that RBI has improved significant rates in the current year, while deposit rates increase after a lag. We've actually started to see acceleration in deposit rates only from November of 22, and that will pan out as we move forward. Coupled with that, we've also witnessed lower provisions. That is to do with the fact that we had tepid growth of the balance sheet for the last few years, which has essentially meant that provisions have been lower compared to the historical rate of provisions. The third aspect is acceleration of credit growth itself. So if you were to step back a bit and look at the previous fiscal year, what we were witnessing clearly across the board was corporates were deleveraging to a large extent. A capital availability from the CP/CD market at rates was significantly competitive compared to the banks. You had a situation where working capital was getting squeezed, so people, instead of taking money for working capital, were actually repaying money back to the banks as working capital became way more efficient. All of this essentially meant that you were sitting on a base where a lot of deleveraging had happened. FY23 has actually been a year where, because of increase in repo rates, what has happened is rates in the commercial paper markets have obviously responded faster. Rates have tightened there faster, which has meant that credit growth from banks has accelerated. There has been an acceleration driven by the entire normalization of working capital, and to some degree, some bit of capexes. So capexes have continued, be it steel, you are continuing to see capexes happen. Be it chemical sector itself, you are continuing to see capex happen. So capex plus working capital plus the shift away from the CP/CD market has essentially meant earning the loan growth for banks has accelerated. Coupled with that, NIM expansion and below normal provisions has meant that PAT growth has been stronger for banks, and hence that part of the market has delivered well. Our sense going forward is the fact that after having reached here, next year, as we look at the same thing, we essentially believe that NBFCs, which actually bore the brunt of an increase in cost of capital, will be in a situation where most of the loans will start getting repriced. We've seen some degree of contraction in NIM there. That starts to get normalized as we move into the next fiscal. On the bank side, we will start to see catch up of deposit rates, and that will mean that there will be some degree of pressure on the NIMs. You will see normalization of provisions on the credit cost on the banks. And hence the focus will now again shift back from a more medium to long-term perspective on the equation of ROE growth and quality of the asset book. Our expectation is in that environment, we will start to see catch up as far as the performance is concerned, both in terms of earnings and as well as the performance of these names. Second big drag has essentially been auto. Within autos, we have been focused more on the auto hank side, because we believe that there is obviously a large degree of shift that we are witnessing in automotive globally, where ICE is being replaced by electric. So that is a transition of the powertrain that is happening globally. We have exposure to one particular name, which is obviously exposed to the right side of this transition. However, given that that exposure also has a large degree of export component, and what we are witnessing in terms of demand globally, it has essentially meant that while earnings delivery has been in line with our expectation, there is a degree of the play out that happens because of the expectation or anticipation of global growth. Having said that, when we look at the more structural driver there, we've actually seen order book improve significantly from 10,000 crore to 23,000 crore today. They've kept on adding new products. And we believe that you will start to see acceleration in earnings growth as we move into the next calendar year, and as most of these new campaigns start to ramp up. And we continue to believe that we are on the right side of energy transition. Apart from this, in terms of allocation effect, obviously we've had some degree of negative allocation effect that has come from the chemical space itself, like I was highlighting. We have actually witnessed some amount of slowdown in global growth. So businesses that were exposed to exports have witnessed some degree of destocking. That has meant that there is volume growth that has got shifted. Given the heightened volatility in commodity prices, in certain cases, we've also seen some degree of margin pressure having played out there. Having said that, as we look forward, our expectation is Domestic growth will continue to accelerate. That will provide a lever for growth. Additionally, on the export side, at some stage, we will start to witness the entire restocking cycle that will play out. Coupled with that, we are now starting to see normalization and volatility on the input prices. That means margins will gradually start to inch up, and that should lead to acceleration in earnings. So, summing all of the performance up, I think the difficult period of CY22 was driven by the fact that we were in a very volatile environment as far as input costs are concerned. We were in a volatile environment as far as growth itself was concerned, and some degree of the factors that I just highlighted, which have played out. Looking ahead, our belief is that as earnings accelerate going forward, performance should start to improve behind that, as on the longer run we witnessed earnings has been a larger driver for creation of wealth over a longer period of time. We expect acceleration to first start on the domestic side. Coupled with that, as the export leg also starts to contribute, I think earnings will also accelerate as we move into FY25 and 26, which is beyond 24. I will take a pause here and we can open the floor up now for question and answer.
Thank you so much, Chetan. There is a lot of interest building up with multiple questions already been raised. First question being, till 2018, performance for India Select portfolio was good, even doing better than our flagship product, the IEP strategy. However, post 2018, there has been inconsistent performance on the portfolio, with underperformance creeping in over a few years now. There have been investors who have been with us for over 3-4 years facing underperformance on their portfolio. How do we address this? What are the reasons for the same? What action steps have been taken to make up for that gap? How do you see portfolio performance going forward?
So thank you for that question. And like rightly pointed out, I think till FY18, so FY18 was probably the first year where we started to see underperformance. A large degree of that was driven by our exposure on the PSU side. We've taken learnings there and we moved on from there. If you look at the way things were stacked up right before COVID, and that is quite essential. I think Feb 2020, we had recovered all of that underperformance and we were in the positive territory at that point of time. The portfolio was essentially positioned to gain from acceleration in economic growth, which we were anticipating. So we had a higher degree of weightage to financials. We had a higher degree of weightage to consumption, and what we were anticipating was acceleration in earnings growth that would happen. Having said that, as COVID hit us, I think in the initial period, we went conservative on this portfolio. What that meant was there was underperformance that opened up in the period of the opening up that happened after COVID. We did not anticipate such a swift opening up that happened. So a degree of underperformance opened up in that period itself, which is FY21 and CY20. The next year, we saw some degree of catch up. And what you're witnessing today in terms of what is dragging the 3-year performance and the 5-year performance, to a large degree is a phenomenon of what has happened in the current fiscal year. The current fiscal year is essentially pulling down a lot of that performance. So we had recovered the underperformance by Feb of 2020. And I think we moved into a more conservative territory, starting to see catch up in FY22 and 23 is really where that has opened up. Having said that, the way we look at addressing this and what we've done throughout this period as we were underperforming is remain extremely focused on the more medium to long term. Look at where we believe the potential for earnings growth married with our philosophy of high quality management, high quality of business, and size of opportunity, where we believe that opportunity remains strongest. We allocate more money there. So like I've touched upon in the way the portfolio is positioned, the places where we are overweight today are the pockets where we believe we will see acceleration in earnings growth over a more medium long term. The idea is to catch up performance on the back of delivery of acceleration in earnings growth. And our expectation is we will actually start to see that happen from FY24 onwards. While near term volume demand itself remains a tad bit tepid, our expectation is that accelerates, and those are the pockets which should start to deliver in earnings growth and catch up as far as the performance is.
Okay, the next question is, We have seen a hit on the quality side of the market in calendar year 22, and that is where we are positioned. How do you see calendar year 23 behave, keeping in mind the tailwinds and headwinds that can face the portfolio and impact of FPI flows on the ISP businesses?
So like rightly pointed out, I think what has played out is obviously a fact that you have seen it's not a function of quality businesses have suffered. What has essentially happened is because of cost of capital going up globally, you have actually seen an impact which has happened in terms of the adjustment that has happened. The difference is that the cost of capital increase has been extremely rapid and sharp, which has essentially meant that businesses which were getting discounted at a future profit rate at a lower rate have started to adjust to a reality of higher cost of capital going forward. Having said that, our view continues to remain and we continue to be married to our philosophy of high quality, high growth businesses. We believe these are cycles. We've seen this cycle play out historically as well. We continue to play in this space because we believe that this is something that we understand well, and hence we are focusing on what is core to us, which is identifying high quality businesses where we believe the runway for growth of earnings is longer, and the market macros will do what they have to do. We continue to focus on micro. When we say micro, we continue to focus on modes of these businesses. We continue to focus on quality of earnings growth of these businesses. We continue to focus on capital efficiency of these businesses and the opportunity sizes which these businesses can gain and improve over a period of time. So our sense is that while macro will play its own role as far as our businesses are gaining market share, as far as our businesses are improving on their capital efficiency, as far as our businesses are growing better than the competition within their respective spaces and continuing to manage their edge, we should deliver performance on the back of this. Having said that, as we look ahead into CY23, extremely difficult to say how it will play out in terms of what style will play out. Our belief right now at this point of time is that you will hit a situation where interest rates will start to plateau off. Inflation expectation starts to go off before any movement happens on the other direction as far as the macros are concerned. While in the near term, we expect domestic driven businesses or businesses where the exposure to domestic side is higher, they start to see first signs of acceleration as volume growth starts to pick up and as margins start to normalize, and the tailwind on the export side plays out over a more medium term.
Okay, the next question is, did we see any negative surprises on portfolio companies with regards to businesses and stock performance in the recent past as against our expectation, maybe something like Patanjali, Divi's, Dixon?
So rightly pointed out, I think those two names which have come up, which is Dixon and Divi's, I think in both these names, we have essentially seen performance which has not been in line with what we would have anticipated. We have seen some degree of miss on the earnings itself as compared to our expectation. On Divi's in particular, I think the fact that what we are witnessing globally in pharma is we are witnessing a period of slowdown in volume growth there after a heightened period of COVID-led growth. So we are starting to see that there is some degree of play out of the destocking of the channel even on the pharma side, and that has played out in case of Divi's. We are keeping a close eye there, and we believe that with introduction of new products, you will start to see improvement as far as earnings are concerned, both in terms of revenue growth and normalization of margins, but we are keeping a close eye there. Similarly, on Dixon, I think Dixon, the fact that they have had to come out and reduce their own revenue guidance again has obviously meant that to some degree they have also underperformed versus expectation. We are continuing to watch these businesses closely. Today, we are in an environment where things globally are way more volatile. We are keeping a very micro-focused approach there. As far as Patanjali is concerned, the reason we have that in the portfolio is we believe they can accelerate their entire foods business. And that is what is getting ascribed a larger value as far as value is concerned. In the current year, what has witnessed because of the volatility in commodity prices is the fact that we've been in a period where they have seen essentially mark-to-market losses on the edible oil side. Some degree of that has gotten recouped in Q3, and some degree of that will get recouped in Q4. Structurally, we believe that food business can grow at 15% with some degree of improvement in margin, and that can essentially lead to the creation of value in Patanjali. So we are keeping a close eye on their execution, and that is where the key lies for them, essentially to execute well, to increase their distribution reach, to significantly improve their processes internally. So we are keeping a close eye on their entire execution bit on ground, and we will take a call accordingly.
Okay. The next question is, we saw the announcement of taxation over rupees 5 lakh in the insurance space. How do we see that impact on our set of companies like HDFC Life?
So like it's like mentioned by the HDFC Life management itself, and in our interactions also, what we've learned is that close to 10 to 12% of their APE is exposed to this higher ticket product itself. Having said that, their margins on this is lower than their contribution to the APE. So if the APE contribution is 10 to 12%, their contribution to margin will be lower than that. There are other products in the basket which can essentially fill the gap. And hence, having said that, we are obviously continuing to keep a close eye there. As far as this particular fiscal year is concerned, this will essentially not play out in Q4. I think Q4 will be a last window to sell these products. And they believe there are sufficient levers internally available to manage the 5% or 6% kind of hit that can happen on the margin front from this product going into FY24. From an outside-in perspective, we are keeping a close eye there. We are speaking to managements across the board. We are speaking to people on ground to get a sense of how this will shape up going forward. And we will accordingly act on that name. So obviously, this has come as a spanner, and we are keeping a close eye.
Okay. The next question is, we did see the earnings grow in first 9 months of FY23. However, the portfolio is negative in the same period. Would it be safe to assume that there is a margin of safety that has built in, and with earnings expectation being more buoyant into financial year 24, can we say that the outlook looks the strongest in ISP that we have seen in the past 4 or 5 years?
So rightly pointed out, I think we witnessed earnings growth in 23. The challenge has obviously been stock performance has not been in sync with that. That essentially means that ability to deliver better growth going forward improves. And FY24, as we believe there will be acceleration in earnings. Our expectation is what we witnessed in the more longer term period where stock prices respond to what happens in terms of fundamental earnings growth. You should ideally start to see that playing out. Obviously, given the fact that it is also a play on how flows behave, it is also a play on global cost of capital. While we remain cognizant that earnings will accelerate going forward, the fact that stock prices have not responded this year to that, on the whole, makes the portfolio relatively better placed compared to where we were in terms of possibility to deliver performance and higher returns going forward. So if earnings growth continues or gets delivered in line with what we expect, and even in 24, and the portfolio does not perform that well, that in a way will make it all the more attractive for 25. So as we stand in 23, it's already made it that we're more attractive for 24.
Okay. Another question is, companies in specialty chemicals have seen correction in valuations. What are the factors which can again lead to improvement in the market capitalization of these companies?
So on the chemical space overall, what we witnessed, and like I was mentioning in my opening remark, is the fact that you have two factors today. One is the more medium to long-term tailwind, which is essentially coming from the fact that people are looking to move manufacturing base to India, away from China as they move their supply chains away from China. Europe itself has opened up as a new pocket of sphere where people are looking at India to outsource a lot of that to India. If you were to put numbers, I think the Indian chemical industry in size today would be 170, 180 odd $billion, while exports from China are 170, 180 $billion. So putting that into context, what essentially that means is that any shift of supply chain towards India is a large enough opportunity for Indian manufacturers, and that is a very clear tailwind. Similarly, what we are witnessing in Europe is because of increase in energy cost structurally, they are looking at pockets and places where they can move out a large degree of their energy intensive part of manufacturing, and India clearly stands out there. So From a more medium to long term, tailwinds are all in place. You have tailwind in terms of shift that is happening. What we have to maneuver is clearly the short term. In the short term, what we are witnessing obviously is there is destocking which has played out because of volatility on commodity prices. There is an impact of margins that has happened because of volatility on commodity prices. And both of these factors have essentially meant that earnings to some degree have got pushed out when we look at FY23. So we are witnessing that play out where short run you have still some amount of headwinds that are playing out both in terms of domestic demand being tepid. As we look ahead, our belief is domestic starts to reverse first. At some stage, export starts to come in. And in any case, we've started to witness normalization of the margins because of normalization in volatility in the input costs. So that will start to come into place. Margins start to come into place. One, domestic growth gets volume on the domestic side into place. Two, exports at some stage will see restocking and back to growth, while the tailwind structurally is intact. So you will again witness acceleration in earnings growth. That in turn will mean that the capex that you are witnessing on the chemical space itself starts to get to use, which in turn will mean that you will start to see improvement in capital efficiency as well, which today on the hindsight looks a tad bit depressed because these assets are not delivering to their potential in terms of revenue. And as that happens, you will see improvement in capital efficiency, while outlook remains quite buoyant. So you can actually be in a situation where you again see some degree of re-rating that happens because of improvement in quality of earnings itself, while the tailwind for the sector remains intact as far as longer term growth is concerned.
A couple of last questions. How do you decide to exit from the portfolio, when to be exited from a stock in the portfolio? Is it 2 quarters, 3 quarters?
So the way it is essentially structured for us is we on an ongoing basis evaluate what is part of the portfolio today versus what is there in the available opportunity of the universe set for us. Whenever we find that there is an opportunity which is significantly better in the available universe set compared to what is there in the portfolio, the idea is to optimize the portfolio and replace that name there. Second bit of change typically would happen when a particular name does not do or does not deliver what we expect that name to deliver over a period of time. Given that we hold names for a longer period of time, given that we are more focused on the medium to long term, there is some degree of tolerance that we have for what can happen in the near term, because we believe businesses are not linear, business environment is not linear. You will see non-linearity that plays out. However, till such time that the quality or the structure of business does not get significantly impacted or altered, we have some degree of tolerance to dealing with that volatility. Where we believe that this has structurally changed and our assessment has either been proved wrong, or the fact that these businesses have structurally just changed in a manner that they need to be exited, and we look at the alternate set and say that can we change a particular name from the portfolio. So these are the two scenarios. The third scenario obviously is a situation where we believe today's price aptly captures the future growth, and hence the potential of return from here on is lower than the set that is available to me as an alternative. So that is also a point where we look at exiting names and saying that let's take money off the table and deploy it in places where we believe compounding will be better. For us, at all points of time, it is the marginal compounding of money that we look at, and that is how we decide how the portfolio should be at a particular point.
One last question. What is your view on the interest rates, longer end of the yield curve?
I think this is a thing that we are no experts on, so we typically don't have any view there. The short view that I was highlighting in our conversation, and that we still believe is the fact that it is linked to inflation and inflation expectation. As inflation and inflation expectation globally and in India starts to normalize, that is a period where you will start to see that rates, after plateauing out for some point of time till these inflation expectations go down, that is where you start to see that adjustment happen. So that adjustment always will be a function of two things clearly, be it globally or in India. There will always be a function of expected growth and expected inflation. So whenever you see central banks move, they will typically move. There is obviously a bias of accelerating growth, but not at the expense of inflation, because Higher growth with high inflation destroys value over a more longer term period. And hence, both these things will be into consideration. So our view is that you will reach a stage where as inflation expectation goes down, you will see central banks move and react to that. The structural factors of inflation, essentially, when we look at from a more global parlance, is that today we are in a situation where a large part of the developed or the rich part of the world is obviously aging. And that in turn means that demand for goods and services today may not be the same going forward tomorrow. That in turn will have implication or ramification on inflation. And that is the role of central banks and the way they will respond. So a short answer is, our expectation is, as you see inflation expectation go down, I think everyone will be focused on growth, and that is when you'll see movement on rates.
Thank you once again, Chetan, for your detailed thoughts on the portfolio. And after hearing you, we do believe that the experience of our investors would be back to how it was. A sincere thanks to all the participants of this call for showcasing faith in ASK. And our endeavor would always be to connect with you regularly and keep sharing the updates through the year. We would be sharing the recording link of this call to your email address. And once again, thank you all for joining in today. This concludes the session for the day. Thank you.
Thank you, everyone. Wishing you all a good evening. Thank you so much for joining us.